Hey, good afternoon, Rob. It's great to see you again.
Thanks for having me again. It's great to be back for a second time.
Yes, and our video generated so much interest, and there were so many kind of views on the videos. It was extremely popular on my channel. So I'm super happy that you are back because you obviously deliver a lot of very interesting content for people, and based on your support and the guidance and I don't know if you knew about that, but I actually managed to pass the Sleek certification test yesterday.
That's pretty impressive. So now you have SLI and Sleek. That's a unique company. That's pretty impressive.
Yes, I was so happy. Yeah. You've done a good job teaching me about all the stuff in Sleek and SLI and everything. So I really totally appreciate it because it wasn't it was an easy exam, to be honest. It was pretty comprehensive. According to the ConnectWise University, it took me like 11 hours to go through all the modules, all the 4 modules.
I would say it's actually one of our hardest tests. It's not for the faint of heart, let's say.
It is difficult, comprehensive, but very interesting. And what I did like a lot, especially the module 4, when you had to kind of use the data from this fictional company and use all the tools and really kind of a deep dive into the performance and the assessment and the diagnosis and give a little bit of your own opinion. It wasn't like a ABC test. It was more of a, you needed to kind of have your opinion about the performance and the situation within this company.
Yeah, that's what's really good about that test. It makes you really become like a true consultant for solution providers. So if you put those 11 hours in and you pass, you know that you have reached a certain bar. So that's, again, congratulations that you've reached that. You've been able to achieve that.
Thank you so much. You've been a part of this journey. So thank you so much, Rob.
No problem.
So, but one thing that I was extremely interested in, because when I was doing an SLI course and a test, I knew most of the things in the report because that's the kind of a standard ratios for doing business, and they were pretty easy to understand. But there were 2 very unique or proprietary, I guess, KPIs that I didn't fully understand, and I'm not sure I fully appreciate, how they are structured and what they tell. So I just wanted to come back to you and check on this FEWS and STAR, or how do you call it?
Yep, it's the FEWS and the STAR score, and you're correct. So again, most of the times when you're looking at these ratios, they're pretty simple when you're looking at any kind of financial statement, but these are pretty unique just to service leadership and those that benchmark. It definitely gives some additional insight on how you're running your company in terms of higher performance, or how would you do potentially if there was a recession or just downturn in the economy.
Could we deep dive today a little bit into those two areas, and you kind of help me to understand it better, and maybe kind of share some of the knowledge with the viewers. Okay.
Yeah, let's do that. We have some slides probably we could help work through, kind of get a better understanding. So when we're talking numbers, it's important to have some slides versus me just sitting up here.
Okay, let's add the slides. So here are the slides.
Great. So I think it's really important to understand what these metrics really tell you and how do you do to improve them. The first one to kind of review is that FEWS result. Again, what FEWS really is a financial early warning score.
Financial early warning score. Okay, I understand.
Yeah, so that's why there's some weird acronym like, what does this actually stand for? That's what it stands for. And then the reason we've actually created this was about 5 years ago, when COVID hit. As the whole world was really in an upswing on, what are we going to do in terms of, are we going to running our businesses, and how can we work to improve, or am I in danger? So basically this was created to kind of look at some of our 3 pre-existing metrics we have to kind of put a whole holistic view of, basically, do you have any leading indicators of any risk in your business if there's another recession or just downturn in the economy? And with that, basically the FEWS scoring, again, we mentioned there were 3 areas in the financial report that, a couple of them are pretty common that people don't know about, but I'll kind of walk them through that is, first of all, the overall profit of revenue, which was one category. Then we have recurring revenue expense coverage, which I'll go into detail in a sec, and the current ratio. And basically taking those 3 metrics and calculating a score on, how resilient you're going to be again on a downturn on potentially the economy. And how the FEWS score is actually calculated. We always, also in service leadership, make things very convoluted where you want this score to actually be lower and not high. Typically, when we're looking at results, you want high. That's a good sign. But this, the lower you are, you're actually showing that you're actually in a much better spot in the watch category. Versus if you're in the danger, you have a higher score, which I'll then kind of walk you through what those metrics actually look like in terms of the weighting. Like I mentioned, we have these 3 metrics right here. And the way we weight it on basically is on EBITDA of revenue. That's the highest weighting. You can get anywhere from 11 points all the way to 33. Recurring revenue expense coverage can be anywhere from 7 to 22 points. And then current ratio has the lowest value of anywhere from 3 to 11. Basically, each category, we add up that total that gets you put in those categories.
So in other words, I guess the higher EBITDA, the higher the recurring revenue expense coverage, and the higher current ratio, the better results you're going to get, which makes total sense, right? If you earn a lot of money, if most of your money comes from the recurring revenue and your kind of cash and cash equivalents current ratio, right? I think it's cash and cash equivalents you have a lot of money basically, then your ability to survive for any downturn in the economy, any challenge you should be in a more robust position. Makes total sense.
Yeah, that's basically it. But again, the way we make it odd is if you have a good metric, we're giving you less points, which is a good thing. An example here, if I look at this, if my profit of revenue, if I'm say a product-centric firm, that's why PC, if I'm over 11% profit, I'm going to get 11 points. If I'm in the danger, let's say I'm only making 4% profit, I get 33 points. So again, you want to make sure you're in high profit, but we kind of reverse it because we make things complicated. But that I just want to let people understand kind of the genesis or how we do this calculation. I'll kind of walk you through some of those too.
And is the points range, you kind of came up with this? Is there a kind of a 11? Because initially I thought, hey, 11% means 11 points. That's not really the case. So how is it your internal scoring system, or is there some kind of a formula behind that?
Yeah, it's an internal scoring system we created. And the reason we're able to do that was, again, we've been benchmarking for over 20 years. And we've seen, gone through recessions, the ups and downs of the economy. We kind of looked at overall all our statistics and see what metrics and what ratios really were helpful. It kind of showed, where everyone were able to do really high performing or low performing based off that. So that's where we came up with, say, the first one, that over 11%, which is a healthy spot, versus if you're, under 4%, potentially you're in danger.
Okay, gotcha. Mm-hmm.
And then again, what I wanted to highlight is of these 3 ratios, we put the most onus on EBITDA, which is profit. And I'll kind of tell you more why that is. But the biggest thing when I'm looking at someone's financials, go to the bottom line. Are you making a good profit or you're not making a good profit? You can tell me a lot of other things are going on in your business, but ultimately that's going to tell me how you're doing. Something going over again, why have we chose these 3 metrics? Actually, kind of, you kind of allude to that. If you're in a good spot with your profit, you're going to give yourself more ability to have some reduction on profit and still be, making money. So if I'm making, say, 80% profit for a service-centric firm, let's say I get a reduction of, again, this example, 70% of costs, I'm still going to have 1% profit. It's not great that I'm down to 1%. That being said, I'm still making money. So I'm not taking money off my balance sheet. I'm not as large of a risk. Versus someone who's making, say, 4% profit, and hopefully this doesn't happen, but if they get that same 70% loss of revenue and everything stays the same, fortunately, they're going to be in the red. They're going to be losing a lot of money. They're probably going to be taking money off the balance sheet. They're going to be burning cash rather quickly. So again, someone who has a higher profit margin has more leeway if something were to happen. So that's pretty simple, but you're just kind of discussing the first metric, why it's the most important and why we first talk about overall EBITDA. Another caveat to put on there is we take EBITDA versus adjusted EBITDA, because EBITDA is basically truly what the owner is paying themselves. So it's really cash going out the door, versus adjusted EBITDA is theoretically what you should be compensating yourself, but it's not really cash out the door. So we want to know, what's that cash burn? So that's why we're looking at EBITDA and EBITDA percentage.
Yeah, in a downturn situation, the owner might be significantly reducing his payout, right, as well, to save the company. So for adjusted EBITDA, it's not a very good measure of the situation. But one more question, Rob. I see that for the product-centric companies or service-centric companies, there is a different kind of a threshold for EBITDA. But in a downturn situation, if you're making 18% versus 11%, from the survivability of the company is probably not a big. Is it a big difference? I mean, 18% is always going to be higher.
Yeah. So the reason why we have different thresholds is, historically MSPs or service providers, anything in the service versus VARs, the service people typically make higher profit. That being said, they have more of those fixed payroll costs because they're delivering more services. So they're going to need those higher revenue and higher profit margins because it's harder to get rid of people. Yes, you can make some reduction of your workforce, but it's not an easy thing to do because that's part of the service delivery versus the VAR. And the average VAR, I think, is about 80% of their revenue is coming from product. So if that goes away, overall they have less people in the company. So it's easier for them to make switches, and they're going to have a lower fixed cost typically. In terms of
so it's a reflection of the structure of the cost. The MSPs will have they'll have a more resilient revenue, but they will also have a more kind of a fixed costs, right, with people and also potentially like office space for the people that are working and this kind of stuff. That's not going to be very easy to get rid of if there is a problem. In the product centric, it's true. Whatever you have in the inventory, once you get rid of the inventory, you're pretty much done. And inventory is not necessary, so there is no kind of such a high fixed cost. There's still people in the sales organization, but also a portion of their salary is variable. So there is also some kind of a different situation here. Makes total sense. I understand.
Again, another way to say it, if I'm a VAR and 80% of my revenue is basically product centric, if that all goes away today, 80% of the costs go away too. So it's kind of one for one versus I'm service centric. I'm probably only maybe 20% product. So the remaining part of that is service based. I can't just get rid of my service cost. It's not an easy thing to do. I can't just tell everyone, hey, don't show up to the office tomorrow. That's a big step you need to take. So again, the difference in variable versus fixed costs, why we have these different ratios in terms of profit.
I understand now. Yes, makes sense.
It's a good question on that, just to make sure you can clarify why that is. And then just one way to point out, again, those who do benchmark us, I want to show where that is in the report. And those that don't, they get in some insight of, in our financial reports, we provide a summary of all the high-level financials. We're showing revenue, gross margin, net income, operating cash flow, EBITDA, and that EBITDA percentage I'm talking about. That's that first metric we look at. So it's easy to be able to access when you are benchmarking. And then the next one we have is a recurring revenue expense coverage. So that's another ratio we use. So the first one was EBITDA percentage, now recurring revenue expense coverage. And what that really is showing the portion of your company's expenses that are not product that are covered by your monthly recurring revenue. So basically what I'm doing is, what is my MRR? What's that? And how much does that compare to all my costs except product? Because like the example I showed you, if that products don't happen, those product costs go away. So I'm going to say they're, for the most part, variable. So what are my fixed costs? That's probably everything else. Rent, people, everything else I'm considering as a fixed cost. So we're doing that ratio, what that looks like. And in a healthy spot, you have about 125% coverage of recurring revenue to cover your costs. So basically for every $1.25 of managed services, that kind of covers every dollar of my basically fixed expenses. That's kind of where we're looking at it. And the reason why we think that's an important metric is, that 125, where do you come up with that? Well, historically, what we've seen is when there's recessions, we'll see about a 1/5 reduction of your recurring revenue. It's typically what happens. Some of your clients might go out of business. They might reduce some headcount. So that's going to reduce the managed services fee. So the net effect a lot of times in a real recessionary areas is 1/5 reduction. So if I get a 1/5 reduction, I'm still at 100%. So that makes me feel pretty comfortable in terms of weathering the storm because, again, I know I have this managed service revenue coverage that's 100%. I know recurring revenue is going to cover all my fixed expenses high level. That's what I'm looking at if it's 100%. That's a healthy spot to be in. Again, that's another metric we track in our service and sales productivity ratio, which is here. Again, people that do benchmark see it. Those who do not, just get a taste of what we are tracking. And actually, I'll show best in class right now, which we're showing is 104.4. So that's that top 25% or the most highest value service providers are have 105% coverage. So over 100%. So that's good to see. That's what we want to normally. Industries are at 83 or 84%. So we don't have full coverage for the industry.
And I must say that I've been looking at those reports and they are extremely comprehensive. This is there are many lines to look at, but you really can deep dive. And I understand that to become a part of this benchmarking, you actually have to structure your management books in a certain way, your accounts, right? So you can load this information into the system and then compare it to the best in class, to the industry average. And I think if you are part of the Evolve program, you can also compare to a couple of peers of yours.
Exactly.
I think that's also so there's a lot of kind of a possibility to have a reference points, both from the industry, from the peers, and from the best in class, which is extremely important because sometimes you look at the report and you say like, okay, so it's 104%. Is it good or bad? Theoretically, it should be good, but maybe it's not. Having a reference point helps a lot.
Exactly. That's the benefit of looking at best in class, those top performers, and those are in peer groups. So also can work with their peers to kind of get a better understanding of their financial reports. And also the good thing with benchmarking also is we want you to potentially either rearrange your accounts to our accounts or simply just map what you currently have to map our chart of accounts, or basically ledger. That'll get you the results you need. So you can really start comparing apples to apples. So I'm going to go over the third metric, which is your current ratio. And that's really just taking your current assets divided by your current liabilities. And that's a normal financial ratio. What that's really trying to tell me is, can I pay back my short-term liabilities? So in the real world, how would I look at that? Current ratio, current assets are basically what's in the bank, my personal bank. What's my savings in my checking account divided by what do I in terms of say mortgage or my monthly credit card statements. That's all we're really talking about just for your business. And you want to be obviously in a healthy spot. So really healthy spot, a 2-to-1 ratio. So let's say I'm pretty wealthy. I got $2 million in the bank. Great. Short term of what I got to pay is about $1 million. That's basically a 2-to-1 ratio. Great. I'm in a healthy spot. What we see in terms of where you want to be in any financial downturn, you want that 3-to-1 ratio, 3.0. So looking at what your current assets are, high level also what your current assets in your business, cash in the bank statement, potentially accounts receivable, you had some inventory, those kind of items. Is that 3-to-1 versus what you need to pay in terms of your accounts payable? If you're in 3-to-1, you have some room, some wiggle room. That's good because that means you can pay off those short-term obligations. That's really what we're trying to get at here.
And still maintain your business, right? Because, you're paying off your liabilities. You still need to bring new liabilities potentially. I'm assuming you're still doing business, right?
Yeah, exactly. Again, that's a ratio we have under the balance sheet. So here, best in class, actually 4.7. They're pretty healthy. As you'd expect, they're running really good operations. Industry's 1.7, just as a reference point for anyone that, if you're not benchmarking, take that knowledge to see potentially where you're running at, because that you can calculate yourself in your own financials. And then the FEWS points range, like I talked about, that 22 to 43 means you're in good. You have good safety. You have a buffer going on. 44 to 2 in your alert. And then the red, 53 to 66, you have little safety that you have to kind of really start deep diving to see how can I improve performance there. So what should you do in terms of suggested action items if you're in that spot? Well, first thing to watch, this, again, if you're right now, you're generating positive cash flow, net income, and you're in the watch area, there's nothing really to do, but, let's reverse it. Let's say potentially you have in the watch, but not generating monthly net income, that's a positive. What you need to do is make changes pretty, at some point as possible. You do have the ability to sell yourself to profitability because you have, again, some leeway. So you have high profit, you have decent current ratio, and good recurring expense coverage ratio. But you should be looking for contingency plans, especially with the payroll. So as you service centric, that's the area where you need to start taking a deep dive. And then seeing any other areas you can make some potential cuts. If in the alert, and you're not generating positive net income, again, you really need to make some changes. It's pretty important because you probably don't have the ability to just sell yourself to profitability. You're going to, again, look at payroll and other areas you need to cut, and you got to make them start pretty quickly, probably within weeks or at least in the next few months. And the first area you're going to probably tackle is your selling and general administrative expenses. So either random expenses, maybe travel, or people in those departments. And hopefully you don't, but if you do, then you would look at reductions in your service cost of goods sold. So again, what I want to point out here is you might look at a report someone says who active benchmarks and there may be an alert. But if you're making positive money, you don't need to take this action. I just want to make sure people understand that. It's more about if you're actually losing money each month, you need to kind of go back and say, I have to make these certain action points, or within a certain amount of time, I can be out of business. And then in danger, again, not generating profit, you're losing probably a significant amount of money. At this point, you need to make changes within weeks, if not within that actual week. Definitely can't accelerate to profitability, and you're going to start to make payroll cuts pretty quickly. They should be identifying that right away. Definitely going to have to start hitting up your SG&A, and at that point, you should probably need to touch your service delivery people as well, because you're in danger. You got to really understand who's low performing, what areas you need to start cutting.
So basically, keeping your score at watch level buys you time later on during the recession, to make the right decisions, right? Because if the recession drops in a danger zone, you probably need to move extremely fast and make some very deep, knee-jerk reactions, okay? So It's much better to watch over the years, over the months, the score, because if you, then you can manage your way up, right?
Yes.
As opposed to do some knee-jerk reactions. You can strategically improve your situation step by step by step. If you don't do that, you're running a risk of, if there is a problem, you either need to move super fast and maybe do some mistakes, or you might be out of business very quickly. Yeah,
exactly. And what typically we see is people in the watch areas, even if they're not in a recession, they've already planned out a better, worst, and most likely scenario of budgeting. So they already know this is happening, we're going to operate like this. Versus those in the danger and low performing typically have not thought it through. And that's the ones that should make a quick decision, but now they have to take time to figure that out. And they, like I said, hastily might make the wrong decision. So a lot of it does go with planning and really get ahead of it as soon as you can.
Appreciate this, yeah.
Yeah. So other areas, so just action items, what can you monitor? Again, cash is king. Monitor, manage your accounts receivable. And that's a statistic we have in there in terms of accounts receivable days of sales outstanding in the report. Obviously, the lower you have it, it means a better area because you're collecting your receivables, you're collecting your invoices. That's important to remember because, again, you might invoice a client that shows up as revenue, but it's not money in the bank. That's what you really need to worry about, money in the bank, because that's going to pay the bill. So it's important. What you see a lot of times is when times are tight, people are not going to pay their bills, not going to pay their invoices. It's going to be hard for you to pay your bills. So making sure the A&R gets reduced as quick as possible in terms of the cash. Any way you can have automatic payments put in place, that's really important. And just weekly evaluating your collections on your accounts receivable. Next one is monitor and manage your sales pipeline for your existing and new customers. So this is one we don't specifically track, but it's something that's really important. You should have internal process of managing your sales pipeline. And also you should have created a budget of expectation to your existing clients. And it's really paying attention to that. Because what you're going to see is, again, in tough times, that pipeline really goes pretty small. New clients don't come up as quickly, and your existing clients are going to push back on IT spend. So that's what you want to avoid, and really pay close attention to that. And the final one is, evaluate your revenue concentration risk. If you have a couple large clients that are significantly high, you're going to definitely be in a spot where if you lose one of them, you're going to be hurt. So any single account that's more than 5% of your total revenue should be thoroughly watched and managed closely. So you really need to step your account management and really make sure you're doing QBRs or monthly check-ins to understand that that account is safe or if they're at risk. And also when evaluating all your clients, if any of them combined revenue, if your top 10 accounts make up 40% of your revenue, it's something to really pay attention to because you could have some risk there. So what I tell people is don't fire your largest client so everyone looks great and in line. It's more about how can I bring in more larger clients and more clients overall throughout the year? And also how can I cross-sell as much to my existing clients? And obviously that's going to be easier to do when you're not dealing with hard economic times. So try to do that now as much as you can. Get in a spot where you have less revenue concentration risk on top 1 or 4 clients. That's really important to kind of just have an understanding.
And I think this is also an important message that you might be bringing a lot of smaller clients, right? Because they will not be concentrated, they will not create a concentration then. And if you create your strategy and your offering around automated or standardized offers, it shouldn't add too much of a burden to your organization. It would be very easy to service those smaller customers, and they would give you a lot of buffer in case there is because they will not all of them will not drop in one moment, right?
Exactly.
Maybe some of them that will go. I remember this from managing the business at HPE. That was always important to have like a 1/3, 1/3, 1/3 portfolio. 1/3 was a big customers, like several big customers, like enterprise business top accounts. 1/3 was kind of a mid-sized companies, and then 1/3 would be a very kind of a broad number of very small organizations that the revenue was typically going like this, very stable, slowly going up, slowly going down, not a big jumps in this kind of a space. Yeah,
what we find a lot of times is you definitely want to specialize in a certain vertical, but don't rely on just one. So potentially you have different verticals as well. If a recession were to happen, not all verticals are affected the same way. So you at least have some ability where not all your clients are going to suffer potentially.
Yes.
And the financial early warning score, again, we have that in the report. That's available for those that do have that financial report. It's available. Again, we see best in class around that 36 and industry averages around 47. So again, if you don't have financial reporting, it's going to be harder to put that together. That being said, you can go back and calculate yourselves based on what I'm showing you. But again, I want you to have an understanding of what this financial warning score really is. So that was the first one we talked about. And the next one is the STAR score. I want to make sure we're hitting both ends of it, important metrics. So STAR score, what that is, and what does it tell me? So the STAR score was also introduced about that same time as we did in terms of COVID, because we want another metric to really show the speed of improvement of financial performance, either better or worse, of members potentially that benchmark. But this one is pretty simple. The higher the STAR score, the faster the company is improving its performance. So that means I'm doing a really good job, increasing profit, revenue, all the areas that really matter, versus maybe potentially going at a slow pace. I'm a high performer. The scoring, what does it really handle? It's basically 3 areas.
And STAR is also your proprietary benchmark, right? It's not something this is something that was invented by the service leadership and something that you calculate based on your own algorithms and the experience data and the just many years of watching those numbers, and it's not something that can be easily replicated by somebody. Yep.
Exactly. That's basically what it is. So we use 3 factors, same like the FEWS, 3 factors, but this time it's all everything from the profit and loss statements. First one being revenue growth. So we base the past 4 quarters, the prior 5 to 8. So I'll kind of take it back a notch. So let's say we ended the books in 2024. We're going to look at your last 4 quarters, which is the full year of 2024 versus the prior year of 2023. So 4 quarters versus the prior 4 quarters. That's basically what we're trying to do. So year-over-year growth of revenue.
Year-over-year of the last 4 quarters. So it could be like a quarter 2 through 1 versus quarter 2 through 1 from the prior year. Yeah,
exactly.
Makes sense. Mm-hmm.
Yeah. And the next one is gross margin. Same process. Basically year-over-year growth, year-over-year of gross margin dollars. Looking at that as a second metric. And finally, what is your adjusted EBITDA percentage for the full 4 quarters period? So the last year period, what has been your adjusted EBITDA percentage? Mm-hmm. And then basically the way we calculate
it's an average, or it's an average, right? Of the last 4 quarters.
Yep, okay. The adjusted EBITDA percent. Yep, the average of that. Mm-hmm. Yeah, so in that we have the same weighting. Again, revenues weighted 1, gross margins weighted basically 2, and the most important one, as we talked about, adjusted EBITDA is really important. That's a third, 3 times the weighting. And the way we always look at it is, revenue is hard to grow, but it's even harder to gross margin. And then bottom line profit is the hardest thing to achieve. So that's why we have that rationale. And on adjusted EBITDA percentage, we worry about that more versus change in adjusted EBITDA percentage, because you get different changes, but not showing true growth. So an example being, potentially I might be at, say, adjusted EBITDA percentage of 3. Next year I'm at 6. I'm not going to show a 3% increase. I really care about what that actual adjusted EBITDA percentage is in terms of if it's a high amount. Because theoretically, it could have gone up, but it's not a large amount if it's on a small organization. So we want to make sure we normalize it.
Gotcha.
Again, the first thing we're showing is revenue weighting of growth right here. Again, looking year-over-year growth of revenue, because any business, if you want to grow, you got to start with the top line. That's really important. Grow that revenue. If you don't grow revenue, it's hard to kind of increase the bottom line profitability. Things to remember, though, is not all revenue is equal. Product resale is not as the same worth as services. And really what I care about growing is recurring revenue, that managed services, because it's recurring, as we all know. And again, one of the important things to look at is the weighting. An example here, we're showing someone who had 13% growth year over year. They get about 6 points versus someone who is in the negative, maybe unfortunately declining revenue, I'm at -2. So, this really shows we want to see that 13% of high growth. That's where we're going to need the most points. And the reason why we look year over year, it smooths out the financials. Because if I were to look, quarter over quarter, I might have a bad quarter, or maybe I have some weird financial accounting. That year to year kind of really smooths out everything and gets me a true understanding of what those growth metrics kind of look like. Again, I want to show you where you're seeing that report. This is a metric I'm sure everyone can figure out in their financials and their internal reporting, but in our reports, we do provide that revenue growth year over year, which we see right here on the top hand left corner. So that gives some insight. I think this is showing they had around 17% growth of revenue, so they get the most points there in this category, which is good to see. Next one is gross margin dollars, that growth year over year. Again, that's the second highest weighting. Why do we care about that? Well, you might be growing revenue, but what if I'm bringing in the wrong clients and I'm hiring a bunch of staff to handle them? That's not a good thing. What we really care about is growing gross margin. So if I'm growing gross margin and doing a good job with my service delivery, it affords me the ability to pay off all my expenses and actually make a profit. So growing that gross margin dollars, that's the number one responsibility for all solution providers. Because at any point you can cut your SG&A, but growing gross margin is really theoretically the most important thing to do. Because at a certain point you can't cut SG&A. You're going to cut to the bone. And so what we're really going to do is grow gross margin. That's what we always talk about. It's the most important. An example here, again, if I'm over 13% also of gross margin, I'm going to get the highest points. You see here, they're going to get a weighting of, instead of 6, since it's 2 times the weighting, I'll get 12 points on that. So that's what we're really talking about. You want to see high growth there. And this shows an example of this company. again, our reports, I think it's showing around 20% growth. So they're actually outpacing the revenue. I think the revenue showed 17, gross margin around 20. So theoretically, this company now has the highest weighting for the revenue and also gross margin. And then the final one we care about is adjusted EBITDA percentage. We've averaged for the last 4 quarters.
Yeah, and can you remind everybody what adjusted EBITDA is? Because I think it's a pretty interesting topic, right?
Yep. Yeah. Side note: I am going to be actually doing a webinar on adjusted EBITDA, part of the service leadership. That's actually happening tomorrow, because that's a common topic people really ask us. So adjusted EBITDA, what does that really mean? Well, we're basically taking your financial earnings and comparing them apple to apples when I basically normalize what the owner's paying themselves. So the way you look at it is owners could potentially be paying themselves different amounts. That's perfectly viable. Maybe they have a certain tax strategy. But if I were to acquire this company and this owner were to leave, what is that? Basically, I would absorb that position. I would need somebody doing that responsibility. So I need them to understand they're making that market rate, that fair market value. So high level, as an example, let's say someone as an owner, I'm paying myself $100K as my earnings. Doesn't matter the territory, but the fair market value, let's say I should be paying myself at $150. That example, what you would do is reduce their EBITDA by $50K. Because theoretically, they should be paying themselves $150 versus what they're paying us $100. So basically, that's where that normalization happens in terms of adjusted EBITDA. And that's normal, happens when people look at companies in terms of due diligence and doing acquisitions. So in our financial reporting, really what we're doing is normalizing things across the board. And again, why we care about this is it's the most important metric of the 3. Again, I want to see high growth. We see in this example here, someone who's a high growth, they're doing a good job in terms of just EBITDA percentage. Their service centric should be over 13%. Product centric, it's 9. Versus if I'm only making a negative profit, let's say of 0%, that's not good. My weighting there is going to be -6. So again, really matters in terms of growing, have a high EBITDA percentage.
And here you're doing the adjusted EBITDA, not the EBITDA, right?
Yeah. And the reason we're doing that, so this is not about cash calculations. For the FEWS, we cared about conserving cash. So we, again, wanted the actual EBITDA, which is actual cash here. We're trying to normalize performance in terms of profit to compare apples to apples for all service providers. And that's why we're using adjusted EBITDA.
Okay, makes sense.
Yeah. And then a common question is, why are we using this adjusted EBITDA percentage opposed to the, like I said, changing of the EBITDA percentage or just increase of adjusted EBITDA dollars? And then we have a quick example here. If I measure the change of adjusted EBITDA dollars, would it be very useful if I showed that I went from $1 to $1,000? That improvement's $1,000, 1,000% improvement, I should say. That might sound good, but again, I'm going from $1 to $1,000. Not much value there. So that's why it's more important to show actual EBITDA percentage. In this other example we show, I went from 1% to 3% year over year. It's theoretically a 300% increase of EBITDA percentage. But again, that's not really showing me I've improved performance going 1 to 3. What I really care about is that number at a high value. I want to see that, say, be at 30% EBITDA for the full year. And that's why we're showing using that metric. Yeah, that's a metric typically you see in the financial reporting. We have that on one of our charts. It kind of shows, tracks overall high performance. Again, scoring methodology, again, on the 3 areas in terms of revenue, gross margin, and adjusted EBITDA. Best high performing company, they'd be on revenue. They would have grown over 13%. That'd give them 6 points. Their gross margin is also growing at 13%. That'd give them 12 points. And then adjusted EBITDA would be over 13%, and that'd give them 18 points. So they hit that across the park. They'd get 6, 12, and 18. That'd give them a score of 36. That company's doing a great job. They're a high star score. For someone who's not doing well, you'd see they're losing money and they have negative EBITDA percentage. They're probably at -12. And that's how we're using the calculation. Okay. Then how we designate performance, we're showing that here. The star score soaring over 28, rising 11 to 27, and then those that are lagging are 10 or less. So then the question is, how do I increase performance? I'm going through this, and you see each category. What should I be worrying about? Well, first one is, retain the clients you have. It's always so much harder to replace them when you lose clients. So it's really important to do a great job with service delivery and keep your clients. Every time I lose a client, it probably takes 5 times the effort to get a new one. Let's be honest. Other points to really.
So many companies forget about it, Rob. So many companies forget about it. I think that this is such a golden rule. That retaining customers is so much important than running after. I mean, it's important to get new customers, of course, but you shouldn't lose focus on your existing customers. Keep them happy.
Getting those existing customers, I mean, it really starts with some good service delivery and also great job with account management. Make sure you're delivering what you promised them. If they are happy being a customer with you, it's only going to help the organization. I always tell people it's important to lead with service, then worry about sales, and that will come versus trying to be a sales-led organization. Next one being, cross-sell as much as you can to all your clients. Make sure they're consuming all your offerings. That's really important. We typically, of the top providers of this best in class, they normally get the lion's share of their clients' wallet. They're obviously getting more return for each client. They're consuming more of their offerings. That's really important. Again, that comes down to identifying the right clients. They're going to consume all your offerings. Next going to be increased pricing. This is mandatory. You have to constantly be on this nonstop. If you're not regularly increasing your pricing yearly, you're going to be losing margin and losing revenue. You should at least be anywhere from 3 to 5% every single year. It's kind of mandatory. People should expect that. Just think about it. Your vendors are increasing pricing every single year as well. And also, your people are getting pay raises every year, and they should. So you have to make sure you're offsetting those. That's really important.
I've been running the pricing strategy for HP for several years. So I've been teaching, a lot of companies, and internally we've been having a lot of discussions about how to manage prices and where to manage them, how to charge, kind of recover the value. And it is the best lever you have in the organization for improving your profitability, dropping costs, expanding, mix and all this is important. But 1% of price increase could mean a multiple increase in the profitability. So it's extremely important. Even 1 percentage point, 1 percentage point is important.
Exactly. And again, people get very nervous about doing it, but it should be mandatory. It should be expected. Every organization that's high performing does it. And then what I tell people is, well, if you know what makes it easier, do a good job of service. If you're dropping the ball on service, it's going to be a little awkward, but stand behind the value you're providing. If you're doing a good job of service, you should charge more. Think about it that way.
Yep.
And the final one is get referrals. Again, if you're doing a good job of service delivery, people are going to be happy with what you do, and you're going to get more referrals. So really what you want to do is, work with your current clients, just discuss with the decision makers. If you're doing the QBRs, bring them up to them, ask them for potential referrals. That we see is the most successful. Every single QBR bring up, we feel like we're doing a great job. Anyone in your network you feel potentially there's the need for IT services. Make that a constant agenda item. Make sure it's happening, and also have marketing manage that referral process. So they're also involved. They'll make sure that it's more systematic, and you'll be able to get more referrals. And that will drive overall revenue, which is really important. So that was the first one, talking about revenue increase. So how can I excite performance on gross margin? Again, on the products, raising prices, doing the QBR. So how does that work? Well, if I'm doing a really good job with the QBR process, theoretically, what we've seen with the best, highest performers, at the end of every single fiscal year, I'm meeting with my clients discussing the IT budget for the following year. So let's go back, say, the end of 2024. I'm discussing with my client. We want to make an IT budget for 2025. We're going to install these many items in terms of your environment. We've created a budget now, let's say, of 100K. Let's get sign off on that. That's the approach you want to make sure you tackle. So make sure you get sign up on that IT budget ahead of time. It's going to avoid any back and forth in terms of quotes that happen throughout the year. All the clients are going to care about is we have a budget of 100K. We're going to use it. It's not about this potential computer $1,000 more I see on the market versus whatever that conversation. You're working to a budget. That's going to really reduce the overall price elasticity you're seeing across the board in terms of clients kicking back and making issues. That's really important. Also looking at making vendor selections based off services where you can be the highest profit. And once you decide that, buy as much as you can from that vendor to maximize, obviously, better back-end rebates as well. Also bundling products, and don't provide as much information on a quote as possible. Anywhere you can potentially bundle as much obviously has some mystery in what's going on in terms of your pricing strategy. And the simplest one, set product gross margins, floors, sales rep understand what they need to receive a commission. So let them know if it's under, say, a 20% margin, you can sell it, but you're not getting a commission on that. That'll train them to understand we have certain price points we need to make sure we're charging for. So
I think there's one more thing that I'm missing, or one or two things that I'm missing here. One is the changing the product mix. It's obviously something that you should be looking at, because you might be selling more higher value products, replace them over time with your customer. If you are selling the products on the services, you typically have a very flat kind of a approach, but you have an opportunity to change the product mix of your product portfolio with the customer, and that could mean replace some projects or some contracts with another one that is just delivering a more advanced product, frankly selling on the features.
Yeah. Exactly. I think it's important, especially on the product side. If your VAR that you'd be concentrating on is selling as much product as possible in terms of the most value you can provide. On the service side, what we say is, what technology can I install in all my all my clients that I don't accept 100%? I don't want these one-off solutions, but what value can I provide? So every year I should be evaluating my next technology upgrade, identify that, and then cross that to all your clients, all your managed service clients. That's the way, like you said, potentially a way to generate more product revenue as well, and hopefully a good gross margin.
And on a set product gross margin for sales reps, there are very innovative solutions that allows people to compensate salespeople in the product portfolio based on a relative pricing quality.
Mm-hmm.
So there are systems now, or I remember we've been introducing systems where we could tell whether the price, especially with artificial intelligence, is going to be super easy in the future, where you can say, is it a good price for the certain portfolio of products and customers or not? And the average price that you are charging, anything that's on average, you pay them the good kind of a commission on dollar. If they go above the average price for this kind of a product and customer portfolio, you just switch on the multiplier. And I think it's a very powerful thing, more powerful than gross margin, because in a gross margin situation, many times salespeople start questioning the cost.
Mm-hmm.
You're having a question about the cost, not about the revenue growth, which is a bit of a challenge. Sorry, I'm just.
No, I agree with you. I think as long as you have the software in place that can track that, makes total sense. As long as you're not doing a manual process of that, but anywhere you can incentivize a higher profit, I think it's all for it. Agreed.
Yeah.
And then the next part to go over is services. Make sure you increase your revenue. How do you do that? Well, sell more recurring services. Make sure you're charging from them and don't discount. That's really important. Especially on the service side, you should never be discounting your services. It's really important. We also talk about stick to your target customer profile. So know what that A client is, or the ones that you do very good, successful at providing services to. Try to sell to those. Don't sell to clients that potentially you're not going to do a great job on. It's really important to identify that. Also deploy tech standards. So again, if I'm a managed service provider, at least I want all my clients to have a one tech stack. It should be all standardized across the board. If I'm doing that, I'm going to be working on a simple environment. That's going to reduce the amount of issues that happen. I'm going to need less employees, and also employees that are paid less. So working with simple environments really drives service gross margins. And the final one, again, get 100% of cross-sell, generate more revenue. More revenue against those costs, you can have higher margins. Pretty simple.
I think from the last IT Nation discussions, deploy technology standards and automate processes, right?
Yeah, exactly. That's the next evolution. How do we use automation now? We keep talking about it, but how am I actually going to invest in it and make sure get the most ROI I can on it? That's important.
Because it's potentially helping you to reduce your cost, which means improving your margin dollars, right?
Exactly. Either reducing costs or increasing efficiency, where you can then take on more clients and not to hire. Look at it as well.
That's true.
So the other part is, really talk about doing this ABC client analysis that the high managed service providers do all the time in evaluating accounts, just so you know. So this is an important analysis to look at when we're looking at your managed service portfolio of clients. Basically identifying them by A, B, C, or D, like I said. And the qualifications are, again, are they a target customer profile, that right client? On the full meal deal. So normally what we see is a lot of solution providers will basically have a bronze, silver, gold package. Those best in class, what they do is have one managed service package and be able to sell it to all their clients. So we say, are they on that full managed services deal? And those that I'll say are currently, maybe you have 4 or 5, 6 offers, whatever it is, over time, try to reduce it. If you have 5 today, maybe next couple of years, reduce to 3, and over time 2, and eventually get to that 1. But you're trying to do what is basically that full managed service package that you can make the most profit on. Next thing is, are they aligned on your tech stack? You're going to have one tech stack for all your clients. You evaluate that. And finally, on the full pricing. So we see out of a lot of solution providers, they have those legacy accounts, or maybe they're charging them about half the rate they should be because new clients are at 2 times the rate. Well, problem with that is over time, you need to evaluate that agreement and you need to kind of right size that, or you're not going to make good gross margins. So that's what you need to evaluate. Any good account manager should have this information available and see where they stack up. Now, if I am an A client, again, keep doing what you're doing. Do the QBRs. You're going to be making very good profit on them and have a really good engagement and relationship with this client. And as a B, develop a plan to make them that A client. How can I make them on that full package or get more IT spend or consume more of my offerings? And as a C, okay, maybe making decent gross margin, making someone off them, but I need to do a deep dive and say, are they potentially a B or are they that D client? And then D clients, we all have them. They're the ones that don't pay their bills. They complain about everything, consume your service desk. At a certain point, you just got to, get rid of them. Unfortunately, so you got to raise the price significantly 2 times, 3 times, or recommend a competitor. It's a little awkward sometimes, but
this is the first time that I see a recommendation like that. Recommend competitors to clients.
Yeah. That's if you're smart and strategic about it. Like this one, that's a pain in the butt. Let's get them by a competitor. Let's shift them over. It's a good way to
is it a good English expression, hot potato or something?
Exactly. Right? They're in your hand, throw them away. Exactly. That's the way you want to be tackling those. And the way also we evaluate that is maybe you're in a spot where you need these D clients, they are still bringing in money. Well, what do? Every time you bring an A client or uplift them to an A, now get rid of that D client if you're in a spot where you need them. But the more you can shed these D clients, it's really going to improve efficiency across your organization and drive higher margins realistically. And we've seen that across the board. The solution provider that I work for, we did it religiously. We saw marked improvement. So then, so just actions to improve your financial performance. High level financials, again, this goes to some benchmarking things I always talk about, and then improve adjusted EBIT percentage. On the service side, you can only spend on your W-2, your service revenue divided by 2.5. So let's say I have $1 million of service revenue divided by 2.5. What that tells me is I can spend $400K on my service team. That's like a salary cap I should be working on. If I have that $400K, that 2.5, I'm going to be about a 50% margin on services. I'm pretty healthy. Work to that salary cap. So that's a little benchmark, a little gut feel, back of the napkin way to evaluate how much are you spending in terms of cost of payroll for service. Next one, how to evaluate sales and marketing. You can only spend in your sales and marketing your gross margin divided by 7 if you're service centric and 6 if you're product. So if I get $7 million of gross margin, that's product and service. $7 million divided by 7, I can only spend $1 million on sales and marketing. That's a healthy ratio, the way we look at it. Next, G&A. On your G&A, you can only spend your gross margin by 2.5. And let's say I got a $2.5 million of gross margin. I can spend $1 million in G&A. That's a healthy ratio to be looking at. And then finally, on your gross margin compared to your operating expenses, don't grow your SG&A at more than half the rate of gross margin. So to put it another way, say next year, I'm budgeting to grow my gross margin at 10%. I shouldn't grow my SG&A more than 5%, that 2-1 ratio. If I'm doing that, I'm going to leverage good gross margin growth and probably have good profit. That's the way potentially I'll be evaluating my financial performance. And then STAR score, where do I find that? That's also in the financial report on the balance sheet section as well. That's available. Then high level, again, that's really is the STAR in the FEWS score. Hopefully, that's some additional insight that people can start using. And if you don't benchmark, a lot of these metrics you kind of start looking at and have an understanding. I think that's really important to understand. High performance, or if we're in a spot where there's a recession, what should I be managing to? What actions do I need to take?
No, Rob, this is great because I like those combined matrices, those combined benchmarks. Okay. Because it just improves your efficiency in looking at the dashboards. Mm-hmm. If you are able to, I remember there was a company that provided me at one point in time like a partner loyalty improvement score. Okay, mm-hmm. And they had their kind of a way of combining different data points into something that said like if this is a 1. It's not so great. If it's a 2, it's great. And they could explain the weights and everything behind it. Then I could look only at one place on the dashboard to track like several different things at the same time. And it's very, very useful. So definitely those two kind of a benchmarks, I'm happy, I would recommend that people look at them. They're available in the SLI report, obviously.
I think you said so much. Sorry to jump in. I think you said it best also. When you look at these reports, there's a lot of data. So what should I concentrate? Well, these are 2. Instead of looking at this whole report, let me concentrate on these 2, and I can hopefully improve performance.
Yes, this is good. This is a good advice. So thank you so much for spending so much time with me and explaining and teaching me and the viewers on those kind of interesting ideas. Can I ask you for one more favor?
Sure, as long as it's not to give you money or anything.
Any next step that you would recommend for people to learn something new, and who should I go and poke and ask for an interview to keep learning about how to improve the performance of the managed service provider engine?
My recommendation is reach out to anyone in the Evolve community. I feel like they have a wealth of knowledge. If you're not in a peer group, you get a lot of value in that, because those that are in peer groups, they do benchmark, and also there's the ability to understand a lot of different metrics and also what's going on in the industry. So that would be my recommendation on potentially who people should be reaching out to get further insight.
Okay, so speak with Dan Scott on the Evolve groups. Okay,
exactly.
I reached out to him. We had one interview already. I think yours was performing better, so maybe it's a benchmark for him to beat.
Oh no, Dan's pretty good, well known too, though. Definitely want to get him on camera, and you want to get him speaking, and want people speaking about the Evolve community.
Okay, Rob, thank you so much. I really, really appreciate it. And I'm looking for some more certificates to do, so that's another thing for me.
Okay? Yeah.
Thank you so much. Speak to you later.
Okay.
Bye.